Hello friends. If you were born before 1966, I need you to find your birth year group in what I'm about to cover because what is happening right now in July 2026 is different for each group. The deadlines are different and the money at stake is different. Some of you have something expiring in the next few weeks. Some of you have a window that closes in 9 months and will not reopen. And some of you are in a group where a correction is owed to you right now, sitting in a DWP system that is waiting for you to call, not the other way around. Find your group, listen to your section, and share this with every member of your family who was born before 1966 because what applies to you almost certainly applies to someone they know. Before we get into it, subscribe to this channel and turn on the bell. State pension rules are different depending on when you were born. And when they change, nobody sends a personal explanation. The people subscribed here find out before the deadlines hit. Subscribe now and let us get into it. If you were born before the 6th of April 1960, you are 66 or older and you've been on the state pension for some time. Most people in this group assume that everything that needed to happen has already happened. The pension started, the amount was set, and the system is working. For a significant number of people in this group, that assumption is wrong. The first thing to check, and this one has a hard deadline of March 2027, that is now less than 9 months away, is whether the amount you are currently receiving is correct. Between January 2021 and March 2025, the DWP identified 130,948 cases where pensioners were being paid less than they were legally entitled to. The total identified so far is over £84 million. The average correction for married women has been around £5,500. For widows, it has been over £11,000. Some women have received more than £40,000 in arrears. The people most affected are women who retired before April 2016 and whose pensions were never uplifted based on their husband's national insurance record, particularly women whose husbands reached state pension age before the 17th of March 2008. The DWP's automatic review of records is now complete. What remains are the cases where the correction has not been applied because the person has not come forward. The DWP is waiting. The exercise closes in March 2027. After that, the right to claim arrears through this route ends permanently. The second thing for this group is the tax letter that is arriving for the first time for a growing number of pensioners. The full new state pension for 2026-27 is £12,547.60 per year. The personal allowance is frozen at £12,570. The gap between them is £22.40. Any additional income at all, savings interest, a small private pension, or any part-time work pushes total income above the personal allowance. Because the state pension is paid without tax deducted at source, HMRC then issues a simple assessment letter, a tax bill, often arriving months after the April increase landed. HMRC sent 1.32 million of these in 2023-24, a rise of 74% in a single year. If one of these letters arrives, it is not a mistake and it is not a scam. It is a real tax demand with a real deadline of January 31st following the end of the tax year. If you were born between the 6th of April 1960 and the 5th of March 1961, you are in the transition zone. And this group is the most urgent of all four in July 2026. The state pension age is not 66 for you. It is not 67. It is somewhere in between. And the exact month depends on your precise date of birth. People born in May, June, and July of 1960 are reaching their precise state pension age right now, this month. Some of the have already passed it without claiming. Here is the exact breakdown. Born between April 6 and May 5, 1960, state pension age is 66 years and 1 month. May 6 to June 5, 66 years and 2 months. June 6 to July 5, 66 years and 3 months. July 6 to August 5, 66 years and 4 months. August 6 to September 5, 66 years and 5 months. September 6 to October 5, 66 years and 6 months. October 6 to November 5, 66 years and 7 months. November 6th to December 5th, 66 years and 8 months. December 6th, 1960 to January 5th, 1961, 66 years and 9 months. January 6th to February 5th, 1961, 66 years and 10 months. February 6th to March 5th, 1961, 66 years and 11 months. That is your number, your specific month, not 66, not 67. And if you have passed that date without claiming, every week that has gone by since then is a week of state pension not arriving. Here is what most people in this group have never been told. When you claim your state pension, you are allowed to ask for it to be backdated by up to 12 months. You do not need to explain why you delayed. You simply ask. On the full new state pension of £241.30 a week, 12 months of backdated payments is over £12,500, arriving as a lump sum with your first regular payment. The DWP does not volunteer this information. If you have passed your state pension age, check the dates above against your birth month. Your first action is to claim. Your second action when you make that call is to ask specifically about backdating to the earliest possible date. If you were born between the 6th of March 1961 and the 5th of April 1977, your state pension age is exactly 67, and July 2026 is the right moment for this group to take 3 specific actions, 2 of which have time-limited windows that are getting shorter every month. The first is your national insurance record. You need 35 qualifying years to receive the full new state pension of £241.30 a week. Every qualifying year you are short reduces your weekly payment by approximately £6.89 permanently. The standard window to fill gaps with voluntary contributions is 6 tax years. A gap from 2020-21 that you can still fill today for around £97 becomes permanently unfillable from April 2027. Each qualifying year you add returns approximately £358 per year for the rest of your life. The investment pays itself back within 3 years and then generates a return every year after that for as long as you live. The second is marriage allowance. If you are married or in a civil partnership and one of you earns below the personal allowance of £12,570, that person can transfer £1,260 of their unused allowance to the higher earner, reducing the higher earner's tax bill by £252 per year. This can be backdated for 4 complete tax years, 2022-23, 2023-24, 2024-25, and 2025-26, producing a lump sum refund of £1,008 from HMRC. The 2022-23 year expires permanently on April 5, 2027. Do not use a paid claims company. This takes about 10 minutes on gov.uk, and those companies can take 30% to 50% of your refund for something you can do yourself for free. The third action for this group is something that did not exist when most people in it last thought seriously about their pension planning. The Finance Act 2026, which received royal assent in March this year, confirmed that from April 6, 2027, unspent pension funds will be included in the inheritance tax estate for the first time. Until now, pension pots passed outside the estate entirely, free of inheritance tax, regardless of size. From April 2027, they count as part of the estate and attract the 40% inheritance tax charge on amounts above the nil rate band. For anyone in this group who has a workplace pension and was planning to leave it to their children or grandchildren as a tax-efficient inheritance, the window to plan around this is 9 months and closing. The decisions made before April 6, 2027 fall under the old rules. The decisions made after that date do not. If you were born after the 5th of April 1977, your state pension age under current legislation is 68. The government is reviewing whether to accelerate that timeline, which means the uncertainty for your generation is higher than for any other group. 3 things matter most right now. First, your national insurance record. The same gaps that reduce older workers' pensions reduce yours, and they become harder to prove the further back they go. The case for checking your record now, while documentation is still accessible and corrections are still straightforward, is stronger for your generation than any other. Second, the ISA allowance of £20,000 per person per tax year, permanently protected from income tax and capital gains tax. The personal allowance has been frozen since 2021 and will remain frozen until at least 2031, which means an effective tax increase every year. ISA savings are the most straightforward defense. Third, the same inheritance tax change that matters for Group 3 matters even more for Group 4 because this group has more years ahead in which to accumulate pension savings before the new rules bite. Understanding now that pension pots will count as taxable estate from April 2027 means that retirement planning decisions in the years ahead should account for this from the start. So here is the complete picture by group. If you were born before April 6, 1960, check whether you are receiving the correct state pension amount and whether a simple assessment letter from HMRC needs a response. The DWP underpayment correction exercise closes in March 2027, just 9 months. If you were born between April 6, 1960 and March 5, 1961, find your birth month in the table above. Check whether you have already passed your state pension age. If so, claim immediately and ask specifically about backdating to recover up to £12,500 as a lump sum. If you were born between March 6, 1961 and April 5, 1977, check your national insurance record for gaps that can still be filled before April 2027. Claim marriage allowance backdating before the 2022-23 year expires, and take advice on the inheritance tax treatment of pension pots before April 6, 2027. And if you were born after April 5, 1977, check your national insurance record now while documentation is accessible. Use the ISA allowance to build a tax-free reserve, and factor the new inheritance tax treatment of pension savings into your planning from the start. Subscribe, share this with every member of your family born before 1966, and I will see you in the next vid.